All right, so good morning, everyone. Welcome to today's macro snapshot. We are recording this on the morning of Thursday, January the 16th, 2025. So let's just immediately have a quick look and see what happened overnight. Not a huge amount, but we did get a bit more progress or some kind of update in Japan. As everyone knows, we have a Bank of Japan decision coming up quite soon. There was a sort of a story placed in Bloomberg overnight essentially saying that the BOJ is getting closer to thinking about hiking as long as there is no sort of market ruckus caused by Trump's inauguration or Trump's early days of policy. So far what we see, if we go back a couple of days here, this is just an intraday tick chart for this is expectations for the January meeting. So you see here on the right-hand side, it's the number of basis points priced in. Of course, 25 basis points would constitute a full hike. So what you guys can see here is that if we go back yesterday, there was that story from Ueda, the governor, basically saying that, they were considering talking about possibly hiking as long as wages continue to show upward progress and upward sort of path of trajectory, and also inflation. And so that kicked things from about, what have we got, about 15 basis points up a couple of basis points. And then last night, as I said, there was a story that the BOJ is now, quite ready to hike as long as Trump doesn't do anything, particularly sort of controversial or market disturbing. So here we're now at 22 basis points. So almost it's about sort of 85% priced in. And if we actually just look at the reaction of the yen, no surprises there that the yen quite like that. So here we have a chart of a daily chart of the US dollar versus the Japanese yen. And what you can see here is that the dollar has cooled off here. So we had the red candle yesterday and down again another percent or so sort of overnight. Well, about maybe more like 0.5%. But it's interesting level here now because we do have on this fib here, it's come back to the 38% fib level. There's a bit of horizontal support there. And also we're getting down towards the 100-day EMA which is at 154.7. So I would say this level down to 154.7 and this other fib retracement 155.1. That's probably a bit of a key box here. Today in the States, of course, we have retail sales and a little bit of data. And obviously we have the inauguration of Trump in a few days. So it seems to me that that's probably not a bad position here for the yen, USD JPY. If Trump does not do anything too controversial, and we don't get maybe a particularly strong retail sales today to strengthen the US dollar, and the BOJ does hike, I can see that the yen he could probably push down a little bit more. So that was one piece of news. Other piece of news is that we had out of Australia, we had employment numbers. So let's just check and see what's going on with the for the Reserve Bank of Australia. And what we can see here is that they have a meeting coming up sort of in February because there's the summer holiday down there. And what we can see here is that at the moment, only about 18 basis points priced of a cut. And keep in mind here that Australia has been one of the most conservative central banks, or let me not say conservative, let me say tight central banks. They haven't started a cutting cycle yet. The Australian inflation situation still remains relatively elevated and sticky. And what was interesting is last night the employment data came in, which was very strong. So if we just actually look, I'll actually just bring up the numbers. Just bear me a second. I'll just bring this up. So the numbers, the headline number was actually pretty good. And as I say, I'll just bring it up, guys. Give me a couple of seconds here. Looks like we maybe have to go back a day. So you can see here the employment change was 56,000 positive compared to 35,000. But what we can actually see here is that there were some downward revisions. And what in my mind is much more important, and I think that for the market as well, is that in Australia they give the breakdown between the full-time and the part-time. And you can see here that the full-time jobs actually fell by 23,000. So it was a negative number for full-time jobs, whereas the part-time jobs was plus 80,000. So that gave us a headline number which, on appearances look quite strong, plus 56,000. But when you start digging into the details, not so great. You also can see here that the unemployment rate ticked up a little bit, so from 3.9 up to 4%. So the point of all this, I'll just put this back to the United States, is that the market, rather than sort of loving that, there was actually a sense that, let's have a look here, that there was actually maybe not a huge change. So we were at about sort of 18 basis points, and as we could see, up and down a little bit of sort of sort of volatility. And as we speak today, about 17 basis points. So not a huge amount. But again, the Australian dollar, if we just look at the chart here of the Aussie dollar, not really loving that number. Particularly, so where are we? If we have the Australian dollar here, you can see that the Aussie dollar actually coming off a little bit against the US dollar on those numbers, just because the part-time jobs is not nearly as good as a full-time job. And as you can see here, the Aussie dollar, just from a technical perspective here, well below all its moving averages. You see here, this is the 20-day EMA, this sort of thin sort of orange line here. And what you guys can see that if we go back, what's that, a couple of months now, 2 to 3 months, it's finding it very, very difficult even to push above the 20-day moving average. So very, very weak price action. There's no sign of a strong turnaround in China. There are some green shoots here and there, a little bit of stimulus. I was talking to someone, a trader yesterday. Their nowcast sort of data is showing that there is a bit of an uptick in consumer spending, consumer demand in China, but that's not yet being sort of felt, as far as I can see, in sort of the bigger sort of infrastructure projects or anything like that, which might benefit a commodity exporting country like Australia. So what you can see here, we're at fairly interesting levels. We've got this very critical level in the Aussie dollar at about 61.7. That's like a double bottom, which is being retested. So again, I think it's all going to depend probably a little bit on China and less so, to be honest, on internal economic data in Australia and the RBA monetary policy. I think at this point, rather than monetary policy and internal data, it's probably going to be more what the US does and if there's any signs out of China. Until and unless we get some weakening, some structural weakening in the US dollar, and the interest rates differentials start coming into, let's say, favor, more Australia and something out of China, I think the Aussie dollar is going to be stuck around here. And if we do get negative news on tariffs after the inauguration of Trump, I can see the Aussie dollar retesting this double bottom at 61.4 and going further down. So there's definitely more downside there. So that's that situation there. Other thing I just want to have a quick look at is the pound. Overnight, you see the pound very, very weak here. This is on the futures on the daily chart. So the pound very, very weak, as you guys can see. Again, like the Aussie dollar, well below even the 20-day moving average. Complete downtrend here. Now we know that the gilts, the bond market has been under quite a lot of pressure. And what's kind of interesting here in the pound, we got last night the GDP. So I'm just going to put that there. You see this level here, pretty key levels we're getting to, which is approximately well, let's call it around about 120, but actually it's about 120 and a half. And basically that could has provided a little bit of resistance. You see a little bit of a bounce, but still a fairly pathetic bounce. We got a GDP last night or overnight from the UK, which was actually weaker than expected. So much weaker than expected. And the problem here even is that's not good for the pound, as you see, under pressure. And even if we look at the gilt market, we could say, well, that was probably good for the gilts. And there was a little bit of a bounce. So that was actually yesterday, but we see overnight really not much of a bounce on that softer GDP number. And maybe one reason there is that because if the UK economy underperforms and we saw the GDP was lower than expected, that means that there's less kind of fiscal space for the Chancellor of the Exchequer, sort of the finance department in the UK. So they have less sort of wiggle room or fiscal space basically to spend, and so that assumes that maybe there could be even more sort of bond issuance necessary if the overall economy is not doing well, and that explains why there wasn't like really much of a follow through here, I think, in the in the gilt market. Apart from that, a couple of things in the stock section. I'll just grab some tea here. As everyone knows, we had pretty strong bank earnings yesterday. We just got a few minutes ago Bank of America. I just had a quick look. That looks like fairly strong. What got my attention overnight as well, we had a TSMC, the semiconductors, huge Taiwanese semiconductors, very strong results and a very positive outlook for AI, artificial intelligence, for the rest of this year and going into 2026. So just for that sector, I mean, maybe that's going to help the Nasdaq today, the semiconductors, but TSMC having very good results, and probably more importantly, a very sort of strong forward guidance just on the overall demand for AI. So that looks as though that's not going away anytime soon. The other interesting thing we just saw, oops, something's just collapsed. I think my Bloomberg is. It just collapsed. No. Is that Target? We just had a sort of Target coming out with some forward guidance. They've just released some information this morning saying that the holiday season, the Christmas holiday season, just finished, was much stronger than expected. So they're basically saying that their forward guidance is strong. So that sort of tells us that the health of the consumer, the U.S. consumer, seems to be very good. And of course, we're going to get some data today. So let's start looking at that. We're going to get the retail sales, which of course is going to tell us a little bit more about the consumer, the health of the U.S. consumer. And basically, that's still it seems to be strong. Target tells us they had a great holiday season. So let's have a look and see what's expected. If we can see here, we had the soft CPI yesterday, as you guys know. But here, let's have a look. So probably, the headline number considered to be 0.6. Really, the most important ones is going to be the monthly number, the month over month kind of core number. So excluding autos and gas, looking for 0.5 or 0.4. So meant to be a little bit better, or the consensus is a little stronger than last time. And then, of course, the control group is also. So be looking at these three core numbers here just to see if the US consumer is holding up and still doing well. If that's the case, of course, the reaction function, it could be good for stocks because we're getting to a situation here where we had a strong employment report last Friday, and we potentially going to have a strong, whoops, looks like something's going on here. A strong employment report but a soft CPI. So that's getting into a very attractive sort of zone for stocks potentially. Of course, there's the risk of Trump and his policies, et cetera, et cetera. But in theory, sort of classically, when you have sort of lowering inflation and you have a robust consumer and a robust economy, that should be, in theory, a pretty good place for stocks. And so far, the earnings, mainly in the financial sector with the banks, the financial sector, but looking good. It looks like we've got Morgan Stanley 4Q wealth management revenue 7.4, estimated 7.3. That immediately looks pretty good as well. The other thing as well to keep in mind is the initial jobless claims this morning. So we're getting that at the same time as retail sales. Again, no reason to expect that to be weak. I think I showed in a recent video, if you look at the last year or two, that is very, very strong. It's anywhere between 200, 220,000, which we're expecting 210, last time 201, very, very strong. So the number of people filing new employment claims is still very low. To have a recession, we need to be in the 300,000 and 400,000 area. We're far away from that and haven't been there for years at this point. So there's absolutely no reason at this point to think that the labor market will show any particular signs of weakness. That's something. The other thing which is probably going to get a lot of market attention today is going to be the Scott Bessent. Now he's the going before the Senate. We've just got Morgan Stanley here. Looks like a big beat here on the equities trading, 3.3 billion compared to 2.6. So it looks like Morgan Stanley coming in very well. But basically, we have Scott Bessent, who's Trump's nominee for the Treasury, Secretary of the Treasury, taking over from Yellen. That's going to be very interesting. He, of course, comes from a private equity and a hedge fund background, a very sophisticated investor. Really, I think what we need is going to be a political theater, as always, in these confirmation hearings. But really, there's two questions the market, I think, could react to if he is asked the questions and if he indeed decides to answer in a specific way. But keep in mind, he's not a politician, so possibly he's going to be more candid and more honest than a lot of the nominees. But the two questions really is going to be on tariffs. If we can try and get some clarity whether on day one, Trump is planning to put 20, 25% tariffs universally on Europe, China, Canada, or Mexico, or whether they're maybe thinking about a more graduated process, maybe 2%, 3% per month, ramping up the political pressure. So that's one question we want to know about tariffs. The second question, of course, is the question of bond issuance. Throughout the period of Yellen under the Biden administration, they kind of front-loaded the front of the curve with a lot of bill issuance and basically neglected to issue that many sort of long-term bonds. So Bessent is on record as saying that he believes there needs to be, the term needs to be sort of expanded and weighted a little bit longer. And so he's basically saying that there's a possibility that they may issue more longer term bonds, so in the 10, 20, and 30-year tenors. And of course, in theory, that would put some upward pressure on the long-term yields, downward pressure on the price, and in theory, should cause a bear steepener in terms of the curve. I don't know that he's going to be specific today, but you never know what's going to happen. So that's definitely something that begins, I believe. I'll have to check, but I believe it's at 10:30 that happens. He already released last night his some remarks, some prepared remarks. I don't know. I don't know how specific he's going to be, but certainly any sense that the bond market, the Treasury will be issuing a lot heavier slate of long-term bonds. That should be a negative for the long-term bond market, pushing up yields, which in theory should be US dollar supportive, and so on. Just quickly, guys, before we sign off here, just want to have a look at a couple of charts. Specifically the equities. Equities had a pretty good day yesterday. I'll just look at as you see, the VIX down. We were talking about the VIX yesterday. The VIX, also the curve, like the forward curve and the VIX starting to go into negative. As you see, a pretty strong down day yesterday. So VIX now down into pretty supportive levels. That's getting to a level where that's going to start attracting vol targeting funds, which prefer a low vol. They will ramp up their exposure to the equity market the lower the implied volatility goes. So that should be a tailwind for bonds today, for equities today. And if we look here at the ES futures, this looks to be like a bull flag. It came back to a sort of fib retracement level. It's trying to break out here, finding a little bit of, just a lack of momentum. But we had a pretty strong update today and, yesterday. And you've got to say that, if it looks as though the PPI and the CPI is relatively soft, or at least, not accelerating, if we have a strong retail sales, we've had good earnings, as I just said. I mean, these are all conditions which, in theory, are should be positive for equities. And as long as we don't get, let's say, if we get a reasonably good number today with retail sales, maybe not even such a strong number, which would, sort of give the sense that the market is overheating. Sorry, the economy is overheating. If we just get a solid number today, no particular surprises from initial jobless claims, no nasty surprises out of Scott Bessent in front of the Senate Confirmation Committee. I think there's a good chance here that the equities could push up at least to this level, which is about 6,045 on the ES futures, or maybe even a little bit higher, up to 6,070 or so. I think there's definitely a little bit more upside. Of course, we have the risk event of Trump on Monday, but I think, today's Thursday and tomorrow Friday. No reason I think why equities can't take a little bit more of a push upwards. As I said earlier, we had from a Taiwan Semiconductors very strong report. So I think the tech sector might be in a sort of a good mood today. So we can look at NASDAQ. I think, you've seen yesterday, NASDAQ had again a big green candle. So that's something which I see no reason for stocks really to be falling off. And of course, if we look at the yields, just if I can find the yields here. Where's my US? Let's say even like the 10-year yield. Yesterday, again, we had a big sort of a red candle down. So yields down, up a little bit today. But that's kind of good news for equities as well. This is the 30-year yield here, just coming off a little bit. So you've got a situation where the yields are taking a bit of a breather. The overall economic situation seems to be pretty good. Earnings seems to be pretty good. Data is positive. So I think this could be like a 48-hour window for some positivity in equities. And the other thing I just want to finish on here is oil. We know that oil has had a nice run up, especially we can look at Brent. So Brent here, positive, but look at the CL1, which is the US contract. I think we rolled over the contract today to March. So it's always a good idea to be looking at the March contracts rather than the CL1, the continuous, because it doesn't really show the roll. But if you look on the CL1 contract here, you see that, the 20-day moving average is starting to move up here, which is the thinner line. So for sure, oils, it's a very complex one because it does seem that this new round of sanctions on 160 oil tankers, two of the major oil producers in Russia, insurance agents, that it does seem to be a significantly more aggressive sort of package of sanctions by the outgoing Biden administration. And I've been doing quite a lot of reading the last 48 hours on it. It does seem, the more I read, that the general consensus is that, especially in the Indian refiners and the Chinese, they basically seem to be saying that there will be some short-term dislocations and uncertainty. And of course, the oil market doesn't like that. So we're seeing a rise in the prices. And we're also seeing the time spreads here. Look at, for example, actually this one here is March 25 to June 25. You see that that's spiking up, has spiked up very aggressively. And if we look at December 25, December 26, not as much, but still quite positive. But the bottom line seems to be, from what I'm reading, is that yes, they are quite significant. OPEC still has significant production capacity on the sidelines if necessary. And the general sense seems to be that the supply chains will reorganize themselves within, it might be a question of weeks, 4, 5, 6 weeks. There'll be, new companies formed and new supply chains and probably new sort of, illegal tanker systems and all of that murky stuff which happens in the oil market. So the real question I'm trying to figure out here is, is there more to go? So on the bullish side, you have, potential for new Trump sanctions on Iran. You have the new sanctions on Russia, which, yes, are causing dislocations to the oil supply chain. Um, and you have a relatively strong US economy, and you also have a forecast yesterday from OPEC, the EIA, and the IEA, the monthly oil reports, which were relatively constructive. So there are some bullish sort of reasons in the oil market, and you also, of course, have financial speculators who, excuse me, sorry, this is a sip of tea here. We also have some financial speculators who are attracted by the fact that the oil curve is very, very steeply in backwardation. So the yield roll is very positive. On the negative side, though, of course, we have to understand that these supply dislocations caused by the new sanctions on Russia will organize themselves relatively quickly. We don't know if Trump is going to further sanction Iran. We have the peace, looks like finally a peace deal between Israel and Gaza, which, of course, they're not oil suppliers, but geopolitically, that will turn down the pressure a little bit geopolitically, hopefully. And then the other big thing, of course, is that the US is massively producing oil up to about 13 million barrels per day. And also OPEC. Plus, we know that they do not think the demand is strong enough for them to ramp up their production, and they're deliberately withholding production capacity from the market. So the market is not stupid, and the market knows that OPEC Plus is underproducing because the actual demand is not that strong. So structurally, the demand is weak. So I'm curious to see what happens here. Could this squeeze up another, $2, $3, $4, $5? Yes, I do believe that's absolutely possible. But and I hate to say this, but my gut feeling, and I'll be watching the time spreads very carefully, is that this could just sort of cool off a little bit. Having said that, inventories in the US, the commercial inventories are at lows. The inventory at Cushing, Oklahoma, the supply point and the pricing point is also at lows. On the other hand, we had gasoline inventories, which are at very high levels. So it's a complex situation at the moment. I think the idea here is probably to be fading extremes. What I want to do, just show you guys, is the new contract, the front contract here. So we have CLH for the March contract, which just comes into action. March 26. We want March 25. Let's not get ahead of ourselves. Yeah, so what you can see here on that contract, it is actually coming up to overhead resistance. So you see here we have a triple top here at around about, let's call it about $79.50, something like that, $79.25. Triple top here. That's going to be it's got quite hard resistance to break. Could it do it? Yes, but I sort of feel that this is going to pull back a little bit, maybe a couple of bucks, and just see what's going on. And by that stage, probably we could have the inauguration of President Trump, and who knows if there are going to be further policies announced. Okay, I'll leave it there. Don't want to go too long. Have a great trading day, and we'll no doubt be talking again very soon. Thank you.